We're watching yields now just below 3% there on the 30-year Treasury. Joining me right now for reaction, Barron senior reporter Mary Childs, along with Kaltbaum Capital Management President Gary Kaltbaum. Gary, going to you first. My goodness, I mean, you know, people are getting a little concerned that interest rates are going to move higher, but shouldn't they? I mean, if you're in a better economy, shouldn't we have the threat of higher interest rates at some point on the horizon? Isn't that normal?
Look, I've been saying for years the Fed's insane. We have 4% unemployment. GDP is in the threes. You got an economy that's strong, and you got markets that are soaring. The Fed funds should be in the threes, not now, if not higher. They're just very easy money policy makers. And on top of that, you got Europe and Japan still negative and printing money. And I'm just hoping at the end of the road, it's not a bubble. I just think they're heroes, and I think they're going to continue the same way they've been going. Very easy.
Wow. All right. By the way, I just quickly, for the viewers' sake, want to mention that we put up the wrong graphic there as this news came out. There is no change on interest rates, no change whatsoever. Mary Childs, not surprised.
Not surprised. The market was expecting this. They've been pricing in 2 rate hikes this year, as noted, but that's kind of, you know, a little bit farther down the road. They're expecting that will not be Yellen's problem. So time's up for her. She can exit in peace. She did her job, and I think the market is pretty happy with her tenure.
Are they going to be as happy with Powell?
It's an open question. I think there's a lot of kind of angst around that because people don't know that much about how he views all of this. They don't know that much about necessarily how he'll conduct the rest of the operations. And there's a lot of fragility in this. The market is very concerned about this kind of gentle raising of the rates and making sure that, you know, it's a very narrow, it's a threading of the needle, right?
Sure. But, you know, if you have economic fundamentals improving, if you have the benefit, Gary Kaltbaum, of tax reform and better corporate earnings and better fundamentals and lower unemployment and higher wages, when Mary says you got to thread the needle, doesn't that help Powell to do his job?
Yes, and he should be raising rates. You know, one of the other outcomes, which I abhor over the last few years, is savers have been ripped off. They have not been able to have riskless income investing, and they've had to reach for yield and markets. And that's why you're seeing markets doing better right now, because they're going into the markets when they should be in bonds. I remember years ago, before Bernanke did his thing, we had money market rates at 4.5% and 5%, and people can put their money into it and not have to worry about risk. That's another issue that has to be dealt with going forward. And again, my biggest problem longer term is I am praying we are not in an asset bubble because of easy monetary policy. It used to be easy money was 3% dropping to 2.75%. Never in our lifetime do we ever think we'd be at 0% for 8 years, and the printing of $5 trillion here and another $10 trillion around the globe. I don't know how they're going to be able to roll that back, but hopefully they get it right.
Yeah, it's a difficult needle to thread. I hope they get it right, too. But, you know, the one thing I think that we can take away from the time we're living in right now is that you are seeing something out of Washington, Mary. I mean, Mary's known me for years, and I was very worried, very, very worried at times with Bernanke's policy and Janet Yellen's policy, because to me that just felt like more money printing. And I kept saying, well, how are you going to actually change what's really going on? Sure, if you have capital to invest, you can benefit from Janet Yellen's policy. You can benefit from Bernanke. But if you don't have that capital, and this gets us back to the middle class, then what happens to you? And maybe, Mary, we're starting to see a shift, and I you know, knock on wood, because people's wages have been going up in the last month. We'll get that data pretty soon, but it's starting to feel like there are fundamentals that can support market levels like this.
Yeah, one hopes. I think that there are a lot of people, you know, the bond market is naturally very skeptical, and those are the people that I tend to talk to, and they are looking more towards credit card totals at a record high, and the last time you saw that was April 2008. That's a source for a little bit of concern. There's been a lot more euphoria in markets, which is great and means that, you know, this melt up, as people are calling it, has been wonderful for people who are invested in the stock market. But if you're not invested, you're kind of not seeing a benefit. It agitates people who aren't invested. They start to get FOMO. They dive in, and that tends to be the moment when things flip, right? And so that's the worst outcome that you don't really want for people who haven't.
You know, the one benefit, though, is that you're not necessarily facing a systemic crisis. I mean, the credit card debt is of concern, but, you know, when you think of what we went through, in 2008. I don't know if anything like that is on the horizon. Gary, I mean, it may be logical that at some point people say, okay, this market is getting a little frothy and I need to take some back here. You know, and we certainly saw that kind of crisis in the year 2000. But in terms of systemic risk right now, do you see any on the horizon?
I think there's one big matzo ball sitting out there, and that's $21 trillion in debt and counting. You know, to simplify it, today, Trish, $2 billion plus was added to the public's debt. Tomorrow, $2 billion, and every day this year, $2 billion, and next year it's going to be worse, and nobody's doing anything about it. And now, look, they've been riding this debt and enabling the debt because of the easy money and the low rates. The question is that we're going to wake up one day and the debt's going to bite back? History says eventually it will.
You know, I talked to a private equity investor a couple of years ago who said something very interesting to me, and I'm going to float it by you. He said he wouldn't be surprised if the United States tried to at some point inflate its way out of debt. In other words, interest rates go up, the dollar gains in strength, all of a sudden all that debt may not be as burdensome. What do you think,
The best thing the United States can do is lower the spending out of the government and let the economy soar. Once the economy soars, more revenue comes into the Treasury, and you start paying down the debt naturally. That's the best way. The worst way is government interference, and that's all we've had for the last 8 years. Government interfering with the market and the economy in ways we have never even imagined.
I think it's starting to stop, right? And we heard that last night. Gary
It's
Kaltbaum.
better.